I'm going to be announcing the next moderator. He's a friend. He's the premier sponsor of the accounting in this entire event. His name is, what's his name again? Oh, Neil. Neil Levine. He's from a small company, Friedman LLP. And without any further ado, let's get the panel started. Neil, please come up. You won a prize. Thank you.
Hello, everybody. You okay?
Yeah.
I got to speak in a mic. Welcome to the panel on with the accountants today. What to know before commencing a transaction from an accounting perspective. And we're going to speak about real-life issues today. Basically, we're going to break the segment into three parts. Frequently asked questions from companies to the accountants, real-life examples, SEC hot topics, and tips for decision makers, how to pick the right audit firm and what to expect. So on my panel today is me. I'm Neil Levine. I'm an SEC partner at Friedman LLP. I'm the co-chair of the SEC department, and I've been with Friedman about 10 years. To my left, we have Corey Fischer, who is the managing partner of Weinberg and Company. Corey, would you like to say a few words?
Thank you, Neil. As Neil said, I'm the managing partner for Weinberg and Company. Based in Los Angeles, our firm specializes in the audits of mid-cap and private companies, but predominantly most of our clients are public. A lot of our clients are in the same space as a lot of the companies that are here today. Prior to that, I was with other national firms, and I've also been a CFO for some NASDAQ companies, so I've got a good blend of both the public and the private side of things.
Wesley Ramjeet from PPMT Strategic. Wesley primarily deals with internal controls, CFO accounting, and I'll let him speak and tell you about that.
Hi. Thank you, Neil.
Yes, speak.
I'm Wesley Ramjeet. I'm the CEO of PPMT Strategic Group. We provide outsourced CFO services, mergers and acquisitions, and the way we sell our services is pretty much solving problems for public and private companies. We're based in New York. We have offices in Florida and California. In terms of clients, we go from biotech startups to public companies. Typically, companies range from startups to 300 million in revenues. That's kind of the way we operate.
Thank you, Wesley. And then we have Justin Van Fleet, who is a partner of mine in the SEC business over at Friedman. Justin?
I'm Justin Van Fleet. I'm a partner at Friedman. I work on both public and private clients, but do most of my time in SEC clients. Been at the firm for about 10 years, working on a lot of SEC transactions, going public, uplisting. So happy to be here today to talk about some of the pitfalls and concerns people are having with going public.
Great, thanks, Justin. So what we'd like to do is I'm going to ask some of the panelists some questions. I hope they all chime in with some of their ideas, and we're going to do something a little different. If the audience has any questions as we go, just raise your hand because sometimes I notice they're forgotten. So anyway, my first question I'm going to pose to the panel, Corey. Public company just went out and they raised some money with convertible notes and warrants. And the auditor was told, hey, what happened to my company here with these liabilities? You hurt my equity. What happened here? That's step one. Step two to the question is with this non-cash earnings hit that a company may have, how can the company report in their 10K or tell the public that we really didn't lose $50 million. It was non-cash and, the company, the operations are fine. So I'll throw that to the panel, but I'll throw that to you.
Yeah, I think the issuance of convertible notes and warrants is one of the most common pitfalls that a lot of us in this audience will face because it really affects microcap companies who can't get the grade A financing that the bigger companies have. And what happens is if you're not careful, that some of the features of the convertible notes or warrants may give rise to what's called a derivative liability, which could have a disastrous effect on your balance sheet and your income statement going forward. Basically, these derivatives are caused by factors such as having a reset provision in the conversion feature of the note or in the conversion feature of the warrant. It's basically a down round protection, and lots of time the lender or whoever issues that note is going to demand this because they want to be protected against future issuances of shares of stock or stock options even, or any other shares that might be issued by the company at a price lower than the conversion price that they initially agreed to. Another way that these derivatives could be caused is if you have a lack of authorized shares. If you were to add up all your shares outstanding, add up all your options, add up all your warrants, and then take into account the conversion features of these notes, if that total exceeds the authorized shares, you can end up with a derivative. And lots of times that kind of sneaks up on companies. They don't realize that. The other area that may cause a derivative, and it's very, very kind of sneaks up on you out of nowhere, is that lots of times the warrant agreements, conversion features, have a fundamental transaction clause. And that could cause a derivative, and I'll give an example of that in a minute. But basically, the ramification is if it's determined that the convertible note that you thought, let's say you got a convertible note, you got cash of $1 million, and you got the note payable for $1 million, you thought, okay, that's fine, there's no effect on equity. Well, lo and behold, there's conversion features in there where the person who owns that note could convert at an adjustable price, or the warrants were given to have an adjustable conversion feature, and a derivative liability is created. And so all of a sudden that derivative liability could have a value, even though you have $1 million note, there was no effect on the equity on the issuance of the note. That derivative liability could go $1 million, $2 million, $3 million, depending upon the features of that note. And that just creates all sorts of disastrous effects for you on your balance sheet. And worse, that derivative liability stays on your balance sheet until it's extinguished, and every quarter you're going to have to mark that to market, so there's going to be continual effect on your income statement going forward. And the results of this is it basically pollutes all your financial statements, and your financial statements may even become meaningless because this derivative liability, which is a non-cash transaction, is going to be so significant, it's going to make everything else in your balance sheet insignificant. But that's the rules.
So Corey, how can you wash it away? I mean, how does the company tell a story and say, hey, we had this derivative, but we really still have operations? It was a complex transaction, a complex debt that we did, and we really have a good company. Can you explain it away?
The SEC currently allows companies to, when they provide information to their shareholders, either in their 10Qs, their 10Ks, their press releases, you are allowed to present what's called non-GAAP information or adjusted earnings. However, you have to be very, very careful when you do this. You present a table that kind of reconciles your cash, your GAAP income to almost like a cash-based income. Now, the SEC in the last year has been very active. They do allow these non-GAAP reconciliations, but there has been a lot of abuses with the non-GAAP reconciliations. And the SEC in the last year has been very active, either through enforcement actions and printing in new guidance about these reconciliations. So they are there, they are allowed, they do explain to the investor what's really happening with the company, but you have to be very careful in using them and making sure that you follow the rules of the SEC in providing that information.
Okay.
Yeah, I would just add to that. I mean, I think the takeaway should be is when you're entering into these transactions, a lot of times, like, CEOs, CFOs are working with the lawyers, and they don't tell the accountants. So, like, get the accountants involved before you sign the agreement, because a lot of times you can change some words in the agreement that ultimately can change the accounting consequence of it. So don't wait until you execute an agreement and then 3 months later tell your auditor what's going on here. So be proactive and give those agreements to your accountants before you sign them. Try to get rid of those clauses.
Yeah, one of the other things I just wanted to mention that could sneak up on you and cause a derivative is oftentimes buried in the last page of the warrant will be something called the fundamental transaction clause, which entitles the holder to convert that warrant to cash if certain transactions occur. And if that fundamental transaction clause is tied to a Black-Scholes calculation, you basically have created yourself a derivative. And I have a real-life example of one of our clients, raised $2 to $3 million. They gave the underwriter a warrant, and the last page of the warrant that nobody would read, it was this fundamental transaction clause that allowed them to convert this warrant to cash if one of these fundamental transactions occurred, which could be things like change of control, maybe a liquidation, something. But the SEC says that's a derivative. So on a $3 million offering, they ended up with $1.5 million derivative liability, which kind of affected what they thought was $3 million of equity.
Okay, thank you. Let's go to another question. Wesley, so private company is thinking about doing an IPO, and they want to issue shares to the insiders just prior to going public, which in essence gives them cheap stock. What have you seen as the pitfalls with that?
Well, as a matter of fact, I'm working on 2 private companies now going public. And, I got the call from the CEO. I want to issue shares to my team and consultants prior to going public because I want to do right by them. Unfortunately for the company and the insiders for that matter, there's ramifications because what the SEC has always said, if you issue shares prior to an IPO, and it can be 12 months, 18 months out, and you're going public, say at $15 a share, and you've issued shares to your insiders at say $1, you're really going to have to explain to the SEC what happened from $1 to $15 that you're pricing today. And they're taking the view that the shares, unless you can prove otherwise, is worth $15. So all the earnings per share calculation you did, it's going to be diluted by that new value they've created of the shares issued. So your earnings per share is definitely going to take a hit. And then there's also tax ramifications because if you issued warrants at below fair market value, you now become not qualified stock options. So now you have that whole issue to deal with as well. So not a very good idea. I think the smart companies typically tend to get valuations closer to the IPO that sort of pegs it to the offering price. So, the SEC is still going to ask a question, but at least you can explain it.
Thank you. Now, what about when the companies that you're handling decide to do an acquisition, a target company? What have you seen the pitfalls in looking for the right company to acquire?
So, there are companies who are really good at doing acquisitions, and then there's, the first-time CEO trying to do an acquisition. And the approach is very different. The CEO who's done this before typically gets his CFO, CPA firm, legal team together, talk about the acquisition, about everything you need to do to make it a successful acquisition. And what we see typically in the first-time CEO, they typically try to get a deal done without understanding from a CFO or CPA viewpoint of what the pitfalls could be. And especially in public companies. We've seen it many times where a CEO goes out to acquire a company. They have a deal in place, but as you all know, there's one requirement for an acquisition. You need to present audited financial statements of the target company. Now, they've signed a deal, but can't produce the audited financial statement. From the SEC viewpoint, you're now defective in your filings. And when we get involved, a lot of times, the company didn't really do proper due diligence on the company. And that's why they're in the position that they're in where they can't get the audits done. Because typically, when you're acquiring these smaller companies, it's usually run by mom and pop type of management. And they've done 3 or 4 acquisitions. They've been around for 10 years. And for you to get audited financial statements is almost impossible. So you really have to have your team take a hard look at what's in front of you and figure out how you acquire them. It might not be a straight out acquisition. Maybe you structure around the deal where you can just acquire maybe the IP, which is the value you're looking for. So there's a lot of considerations you have to sort of take into account as you look at target companies, especially if you're a public company.
And to piggyback onto that, Justin, FASB came out with some new guidance under the ASC discussing the definition of what a business acquisition versus an asset acquisition. How does that affect what may need to be audited and reporting on currently versus what used to be the rules?
Yeah, sure. So, typically when new FASBs come out, and the auditors usually give you bad news, but for once, FASB kind of came out with a good ASC for companies and auditors, really. They kind of, historically, everything's been a business acquisition. Unless you were buying one single asset, the FASB and the SEC really considered everything a business. And what did that trigger? It triggered getting a purchase price allocation, recording goodwill and intangibles, and doing historical audits to roll into the pubco or if you're going public. FASB came out with a new standard that really narrows the scope of what they consider to be a business and really calls it more of an asset. So some examples, a lot of the biotech and pharma industry, if you're buying a license or if you're buying a customer list, historically, both bodies would say it's still a business. It's an input-output process. It's going to be a business, go through the whole process, which is costly and time-consuming. So this new FASB becomes effective in 2018, and it's going to help people, following GAAP, to consider things asset deals and not business combinations. The headache of an auditor's come in every year and say, give us your impairment testing for goodwill, give us your impairment testing for intangibles. That can really go away now because that's going to all be in one asset. So the kind of weird part is the SEC hasn't really changed their take on it still, so there's still going to be some disconnects when it comes to pro forma information and some of the historical audits, but the FASB is taking a clear line on kind of narrowing that definition down, which will help a lot of companies in that process.
Thanks, Justin. I think we have a question here.
I want to go back to IPO share pricing. How's the SEC looking at the company when shares were issued to founders, maybe they were issued at par? Is there any kind of effect there?
Okay, so I'll repeat the question. When doing the IPO, how are the founders' shares treated beside issuing to other consultants as such during the process? Anybody want to answer that?
For the most part, I think when shares are issued to founders, they're kind of outside the scope. What the SEC is concerned about are shares that are issued for compensation to employees, as part of option agreements, maybe in conversion features. So what they'll do is, let's say you enter a convertible note, it could be a convertible note during the year, and you enter in at the price of $2 per share. And then you calculate, back to what I said, you look at maybe it's a derivative, there's something called the beneficial conversion feature, you got to mark that, compare that to a market price. So anyway, there could be an accounting effect of that. Well, 6 months later, you filed to do an IPO, and you're going to file at $6 a share. But you've already done all this accounting at $2 a share. So the SEC is going to come back, and they said, well, your stock $6 is worth $6 a share. So founder shares are usually outside that scope.
I think it's important to note too, we've seen companies try to expand what a founder share is. So, if people are using too many people to give those shares to, they're going to look at it. So if it's 4 months down the road, you give it to some more people, it's going to be tough to defend how it's really a founder share. So you can't just label something, those shares. They're really going to look at the economics behind it.
Right. And Justin, yes, Mr. Kraft.
Can a founder make a distribution to others in the company subsequent to, let's say, prior to announcing an IPO?
So the question is, can the founder of the company that did an IPO gift or give his shares to another party during the IPO process?
Before the IPO.
Before the IPO.
I was going to say, check with your counsel.
There's no, the founder, the founder could give, assuming that you've checked with your counsel, the SEC would tell you that anytime a founder gives shares to someone, that you have to look at the accounting effect on that and why did he give that person or she give that person additional shares. There's something called the SEC Rule 5T, which says that if a founder gives shares to a vendor, an employee, or shareholder, it's basically compensation to that person, and it's a compensation cost to the company. So it does get recorded through the company's P&L, and I'm sure that's probably happened a lot in startup companies where a founder has a great many shares, and instead of issuing company shares, he'll give the lawyer, 100,000 shares, but that has to be recorded at the fair value as a cost of the company.
So the question from Michael is, what about SH shares?
SH shares are company shares. So then you would record those company shares as,
Thank you. Since we're at the MicroCap conference, Justin, when pink sheet companies, what do they face when they're trying to uplist to the OTC, the QB, or the QX, or a national exchange for that matter, when they're looking to upgrade to a different exchange?
Yeah, so I think some of the hurdles when you're going to be presented with auditors coming in, if you're making this uplisting or going public. They kind of talked about on the prior panel is really corporate governance. There's a lot of smaller companies that aren't public yet that it may just be a founder and maybe one other employee in the executive level. But the key really is to get a good corporate governance in place with board members, audit committee formation, because there's really a trickle-down effect. Once you start with that good corporate governance, everything kind of falls behind it. A good internal control environment. These are things that we're going to push companies on when we come in as auditors to say, what's that tone at the top? What kind of controls have been implemented? What board oversight is there? A lot of small cap companies too don't really have the greatest segregation of duties because they don't have a lot of employees, especially in the accounting department. And one of the ways to kind of get around that sometimes is using that board to have some kind of checks and balances and governance around transactions. That's one of the ways to kind of tackle that. Also, it's just quality of historical data. We get a lot of engagements where come to 2-3 years of audits and they really don't have, they didn't know it was coming with the request list and, hey, I have $10 million in revenue, here's an Excel spreadsheet that says I have it. You really got to have, proper documentation going back to all the periods that are being audited and, and really executing agreements to do it. We also find a lot of hurdles with verbal agreements, things through emails. So if you're getting close to that process to either uplist or go public, really just formalizing things, signing agreements, and just building a good internal control environment goes a long way to try to get these audits completed.
And Wesley, sometimes it feels like you need 2 years of audits.
Well, before you get to that,
okay.
I want to add to what he's saying. One of the biggest things, from a audit standpoint, because we're always on the other side of the auditors, and you guys don't see most of the pain. But one of the biggest things that we see is you have founders that run private companies, and they run it like a private company, right? So there's a lot of related party transactions. There's a lot of expenses being run through the business that shouldn't be run through if you're a public company. So I think special attention needs to be paid to that. as you're cleaning your company up to go public.
And to piggyback on that, it seems when you need 2 years of audits, it seems you need more. You go back, you do 3 years, you do 4 years. What's the story there?
So, you talk to the auditors, they'll tell you need 2 years of audited financial statement or 3 years, depending on the size of the company. But if you're a first-time company getting an audit, that's really not true, because the reality is, to get a full years of financial, you actually have to go back to the beginning of the company. So if the company was around for 6 years, you have to go back to the beginning of that company and look through all of their equity transactions to make sure they've been accounted for properly. If not, it would have an impact on the balance sheet for the 2 years you're looking for. And that's true for, most of the material transaction in the company. And, from a practical standpoint, we would focus on, the big audit items, whether there was, revenue contract, stock options issued, shares issued to consultants, any M&A type of activity. And that needs to be, done right from the inception, or you're probably never going to get through the audit.
Yeah, so to piggyback up, we have a question.
Yeah, in regard to uplisting, if you do a Title IV in Tier 2, the requirement is you have a 6-month reporting requirement and an annual. Now, if you uplist to NASDAQ, you now have to go to Qs and Ks?
Yeah, so the question, I believe, is you're talking about Reg A plus, right? So in the Reg A plus, you have to do a 6-month stub, and the question is, when you move up from the Reg A plus, and you want to go to NASDAQ, would you have to follow the NASDAQ rules?
I'm not, each exchange has its own rules, so you're going to have to follow their rules. So I think NASDAQ is, first of all, you got to look at whether or not you're an accelerated filer or a small business filer. The SEC tells you have 2 years or 3 years, but New York Stock Exchange may have their own rules. It just depends upon the exchange's rules.
Exchange rules supersede the SEC rules?
No, the SEC rules will be their basic rules, and then the NASDAQ and the exchange rules will be on top of the SEC rules.
I think most, most Reg A's I've seen, most times they check a box, I think. And they almost report quarterly anyways if they have those intentions to uplist to NASDAQ. So even though you went through the Reg A Tier 2 to get there, a lot of times companies immediately check a box and almost report quarterly, because by the time you're at NASDAQ, you're going to need to do quarterly, because SEC, and you're going to need to show comparative periods.
You have to go back?
If you didn't do it, you'd have to go show it the prior year quarterly to be comparative. So I haven't seen many, most of the Reg A's I see are going to go to quarterly anyways, over-report almost, because they know they're going that direction.
Thank you.
Okay, thank you. Now, going back to,
That's a question.
oh, we have another question. Go ahead.
These days, I seem to be reading about more companies wanting to drop the GAAP reporting to shift to non-GAAP. Do you find this is a concerning trend? What's your opinion about that?
So I think you said the GAAP reporting versus non-GAAP reporting. Are you talking about IFRS, or what do you?
Just in their just general accounting, how they're reporting their earnings.
Okay, well.
Some companies are just saying that better represents how their business, how they do business, and they're justifying switching from the GAAP to the non-GAAP.
You want to answer that?
Yeah, GAAP reporting is absolutely required. There's no way of getting out of that. What you can do is you could do supplementary, provide non-GAAP information in your Qs and your Ks. The SEC will allow that. They have been cracking down on some of the presentation of that. People have been using their own interpretations of what's non-GAAP and maybe changing revenue, and because maybe they collect cash in advance of recognizing the revenue, and they'll do like a reconciliation and they'll add that cash back. You can't do that. But what you can do is maybe take out non-cash items like derivatives, which we talked about earlier, stock compensation cost, to get it sort of to like a cash basis or to an adjusted number. But you absolutely have to use GAAP in all your filings.
And the SEC is never going to let the non-GAAP number be more predominant. So as simply as like, we've seen comment letters like flip your table, like you can't start with non-GAAP. So the SEC is never going to allow somebody to make that number really be more relevant than the GAAP number.
And Corey, going back to what Wesley said, maybe doing 3 years of audits, we've noticed that we hear complaints, our compliance testing, our sample size are larger, it's taking longer, why aren't you guys done yet? Are you just trying to run up billing, or what's going on?
Our firm? No. I think everybody's probably aware that with Sarbanes-Oxley rules, there was the creation of the Public Company Accounting Oversight Board that is responsible for the oversight of the auditors, and they routinely inspect the audit firms. Major firms get inspected once a year. The other firms get inspected 2 to 3 times a year. And the existence of the PCAOB, they created their own set of auditing standards, public company accounting auditing standards. And their interpretation, I think, was a little different than some of the old existing GAS interpretations, generally accepted auditing standards. And what's happened is the PCAOB in a lot of areas is looking for significantly increased sample sizes of what the auditors used to do. In the old days, maybe we were testing revenue. You might pick 32 revenue transactions and think, well, there's no errors, there's no real effect on the financials, and go on. Now, some of those revenue samples are now going up to 200, 300, 400 selections. The PCAOB has created significant anxiety for all the firms. That means that all the anxiety that we're feeling is being pushed back to our clients to ensure that we are doing audits in accordance with the PCAOB standards. There's a lot of feeling within the firms that no matter what you do, the PCAOB is going to get you anyway. Yesterday, the PCAOB just released its report on BDO Seidman, which is obviously a great firm, one of the biggest firms, and they had 75 pages in the PCAOB report. It was one of the longest ones I've ever seen. And it's so anyway, that's all being.
So they picked out, like we were talking today, 15 deficiencies out of 26 audits.
Right.
So more than half of their audits that they did and that got sampled were deficient.
Yeah. So according to the PCAOB, 50% of the work that BDO Seidman does is deficient, or didn't have the ability. They didn't have enough information to issue a clean opinion, which is practically absurd because obviously BDO is a great firm and they probably did it. But the interpretation of what the PCAOB done is so tough now that the auditors are forced to increase lots of sample sizes. Lots of things that we've done in the past have changed. Most of the comments that are coming out of the PCAOB relate to auditors' testing of internal control for financial reporting, the 404 testing. I'm not sure how much of that affects clients here. But a lot of the other comments that come from the PCAOB relates to revenue testing and testing of fair value measurements, things like goodwill testing and impairment testing. So they've been very, very tough on the firms about that.
Okay. So getting back to Justin, I wanted to ask you about when you're ready to go public, some of the accounting hurdles that we found, to piggyback on one of the other questions we had.
Yeah, sure. So kind of what Corey's talking about too, some of the reasons why there's a pain point for a lot of people trying to go public, and they get the auditors coming and asking questions. Some of those items it's good to consider before you do it is, we have independence rules. And one of the first things we always hear is, why do I have to write the financials? Why don't you tell me how to do it? And that's really a difficult thing to us to explain to them because we can't, audit our own work. So, we do a lot of times, we give recommendations, people like Wesley's firm comes in, but sometimes it's a hard pill to swallow for firms because they feel like, why do I got to hire 2 accounting firms to do one audit? But people need to understand that we have pretty strict independence rules where you got to give us, a financial statement that we can audit and look at, and we can't be involved in drafting that financial statement, which is completely different, obviously, when you were a private company. Your audit firm could do both. You could write the financial, you could audit the financial, and you'd help out a lot more. So there's really a strict guidelines there. Another thing, and what Corey was talking about, is the complex debt and equity. With the difficulty in financing and not getting Type A financing, there's a lot of accounting mumbo jumbo, we put it, that goes into all these complex deals that can lead to a lot of accounting entries that don't make sense to the company, let alone the public, really. That's one of the hurdles there. And with that, too, is also valuing stock and valuing transactions. Even if you're a pink sheet company and you've thinly traded stock, it's hard to come sometimes with the value, how to value the stock going out, how to value acquisition-related stuff. So these are hurdles that, because you're a private company going public, that you should be hearing your auditors challenge you on, and you're going to have to get through the audit.
Yeah, thank you. Corey, we were talking today, and you were telling me about one of your companies had a valuation done, and they paid $25,000 to have a valuation done, and yet the auditors are now questioning the valuation that was done by the valuation experts. So you want to comment on that?
Yeah. If a company goes out and does an acquisition, there's going to be a purchase price, and that purchase price needs to get allocated. And that allocation is usually going to be to some sort of intangibles, or it's going to be to goodwill. And then subsequently, once that goodwill or intangible is recorded, every year it's going to be on the balance sheet. Well, to record that valuation initially, and then also to do your annual impairment testing, you're going to need to do some sort of valuation, and you're probably going to have to bring in some sort of outside valuation firm to do that, and those guys are probably not going to be cheap. So you go out and you get this report, and it comes up with these numbers, and then all of a sudden, your auditors get hold of it, and now the auditors are going through it. And again, this is a direct result of PCAOB standards, where the auditors are required to test all the assumptions that go into that valuation report. And it's not difficult. It's not easy. It's very difficult to ascertain what some of these valuations are. A lot of them relate to discounted cash flow. A lot of it, you have to go, and discounted cash flow is obviously based upon some sort of cash flow. The auditors have to determine whether that cash flow is realistic, if it's based upon historical trends. There's a lot of work that goes into it, and it's very, very subjective. One of the things that's happened over the last year or two is that the number of impairments of goodwill has gone way up, because companies just can't justify to the auditors the carrying value of goodwill. Now, if you're Microsoft and you go out and you acquire a company, pay a good purchase price, there's probably cash flow there to support the carrying value of those assets going forward. But I think for most of the companies in this room, you go out, you do an acquisition. A lot of the companies that you acquire are startup, or may have been other reasons to do the acquisition. It's very hard to justify the carrying value of those companies going forward when there's losses, and it's very difficult. It's a very difficult audit area.
Thank you. Okay. We do have a question. Oh, we have more to do, Lulu. Well, I wanted to ask Wesley anyway, from a CEO's perspective. When you're doing acquisitions, you may want to talk about, what have you seen with timing, with money that's necessary, roll-ups, options in the industry, and I wanted you to elaborate on that a little bit.
Sure. There's a saying that says, the acquisition you didn't do was the best one that you've done. Because too many times we've seen a lot of companies go out and acquire companies or try to acquire companies, but they haven't done their homework in determining whether this is a good acquisition, a bad acquisition, or it's a strategic fit. A CEO should, when he's looking at an acquisition, should first, do his homework, get his finance team involved to assess the deal from a financial perspective, to see if it makes sense. Does the combination of the two companies provide a decent return on the money that's going to be invested. Also, as part of your team, you should get your business people involved to determine whether the way that company is doing business versus the way you do business makes sense from a culture standpoint. From a legal standpoint, you definitely want to get your attorneys involved to identify any potential issues out there. And in all of that, if it's a public company, you definitely want to make sure you can audit that company. The way we typically advise our clients, it's, before you go to step one, let them produce audited financial statements. Because 9 times out of 10, it's a bad deal because as you go through due diligence in these companies, they start out at $5 million of EBITDA, and by the time you're done, you're probably at $300,000. So that's kind of been, my experience.
Thank you. Any questions from the audience regarding any of the subject matter? Mr. Kraft?
How do you, as a private company CEO, determine what amount of shares you should accept from a publicly traded company based on the value of your company and your mind with the amount of private company shares you have? In other words, how does the private company determine how many shares of the public company they should get? Where does that number come from? How do you value the private company? That's really the question.
You repeat it?
Oh, I have to repeat that.
Good luck.
So Shelley asked a great question. He said, hey, for the private company that's going into the public company, how do they value themselves to make sure they're getting the correct shares as it's relate to a monetary value and potentially a control value?
So Shelley asked me this question before. And my answer to him
so
was,
that's a ringer.
my answer to Shelley, get as much as you can. But the reality is, first you have to put a value on what you think your company's worth. And then it's math, right? So if you think your company's worth $10 million, then, doing the math in terms of how many shares that equate to, then it becomes a mathematical calculation.
Should you get double the amount for the private company in case things don't work out?
Well, so that would be you don't necessarily get double, but you can have a price protection in your agreement. So if the shares drop to a certain, beyond a certain value, you get additional shares.
Okay. I have a question. Justin, what about the timeline for getting audits done? It seems like most of the jobs we get, they're like, Levine, we need this done in 60 days. We need this done tomorrow.
So after Levine tells him we could do it by tomorrow, I got to call him up and say, you don't know. You need to get the information. Every company really is completely different. If you got auditors telling you that you're going to do an audit in 2-3 weeks, you might want to keep, get some references and keep talking to other auditors because it's a long process. I mean, you can hear some of the pitfalls up here, but it doesn't matter if it's the smallest company with not a lot of activity. If you've never had an audit before, it's going to take time, And I think part of the, some of the way to go against that is don't wait too long to do it. So don't spend 60 to 90 days talking to lawyers and the other side and then say, oh, I got to go get an audit. Like if you're thinking you're going to do a transaction anytime in the next 18, 24 months, get the auditors in there. We have a lot of situations where, private companies, they don't know if they're going to go with the VC route or the public route yet, but they know no matter what they do, they're going to need an audit. Sometimes we even come in and do just a review first, just to get some numbers on paper. So don't wait too long to get those audits done and start as soon as possible, because the timeline is never going to be fast enough for what Neil Levine tells you it's going to take. So.
And can you audit anything? Does every audit firm, are you an expert in every field?
No, you got to find the right. When you pick an auditor, see what kind of experience they have. You want to find people that have the experience in your industry, your field. Don't just go with anybody, because there's value to what the auditors know too.
Any other questions? We do have a question. Oh, I have one more question, okay. So, Corey, if you were a company looking to pick an audit firm, would you read their PCAOB last inspection report? And if you did, what would it tell you?
I would think that that's probably the first thing that you would want to look at, because the PCAOB inspection report will give you a good bird's eye view of the quality of that firm, and especially with the smaller firms that audit the MicroCap. Mentioned earlier, a firm like BDO got a pretty lengthy inspection report, a lot of deficiencies. But listen, BDO is a great firm. The Big Four get a lot of deficiencies in their report. There's a lot of complicated issues. Some of the smaller firms, though, if you start digging into their PCAOB reports and you see more than 3 or 4 or 5 deficiencies, that's a pretty good indicator that there's problems there. And if you decide to hire a firm, a PCAOB firm whose quality is questionable, that's going to follow with you in a number of reasons. It's going to follow with you in case you try to do a good investment banking deal. But mostly, the biggest problem is if that PCAOB firm has problems, you have problems, because it's a good chance that a lot of these firms now that are having these problems, they're losing their PCAOB registrations. And that means you can't use their financial statements, and that means you're going to have to go back, and you're going to be a public company, and you're going to have to go back and find a new auditor, and they're going to have to re-audit 2 or 3 back years.
Yeah, and I would just add to that before we wrap up, there's had to be 10 to 15 to 20 firms over the last year that have been suspended, and they're no longer able to practice. And on occasion, we've had to go in, like Corey said, and if they get suspended in a year that they've opined on, they cannot consent to it, so we've had to go back and redo a year. So it's really buyer beware. You can go on to the PCAOB.org, and you can find out every firm's inspection report, who's qualified and who isn't. So thank you very much, and enjoy the rest of the conference.